Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 15th of January 2021, and we're looking at a slightly different subject today. The cost or price of upsetting China. So let's take a look. Firstly, a quick shout out to our video published yesterday entitled Silver Rises on Proposed $2 Trillion Stimulus Package, which, shortly after publication, Joe Biden announced a stimulus package for the American people that he plans to introduce once inaugurated, valued at $1.9 trillion. We also discussed some of its potential ramifications. And earlier in the week, we produced 2 videos on platinum and why it's a precious metal you should at least consider. And they're entitled Platinum 2021 Forecast Part 1 and Part 2. And we also had a rather in-depth look at the potential for the US dollar to lose even more value over time, thereby acting as a tailwind for gold and silver prices in the future. And they were shown in the videos entitled Dollar Declines in Spite of Economic Future Looking Brighter and US Dollar Decline and Debt Clock Part 1 and Part 2. And we've listed these with appropriate links below. Now today we're going to look at something just a little different, a slightly different approach. The cost or potential cost of upsetting China. Now what do we mean by this? Well, firstly, we're all aware by now, based on our previous videos on China, which you can find in our China playlist, link below, and also mainstream media have made much of the fact that China, 1, is the second largest economy in the world, 2, plans on supplanting the US from the number 1 position, 3, is attempting to make its own currency the dominant one in the IMF's SDR special drawing rights basket of 5 currencies, 4, has apparently recovered from the coronavirus pandemic faster than most others and is citing quite large positive growth figures already, and 5, steals and abuses intellectual property rights and have an appalling human rights and workers' rights policies and reputation. Bearing this in mind, and not to mention potential political espionage, the West and the United States in particular have levied various tariffs against Chinese imports, banned a number of their companies from operating in the United States and elsewhere, even pressured successfully the UK government not to go ahead with its 5G program with Huawei, and have encouraged businesses to either move out of Chinese markets or divest themselves as much as possible. Well, all of these actions, whilst in principle appear laudable, certainly politically, have consequences which should not be ignored or pretend that they are not relevant. Firstly, the US trade deficit has worsened under the Trump presidency, in part because of this, not exclusively, but in part. Let's listen to what Forbes published just a day ago. We'll quote them. Both as a candidate and a president, President Trump decried trade deficits. While he is not the first to bemoan deficits, nor will he be the last, Trump made taming them a key part of his campaign. On that score, he will have failed. The 3 largest US deficits in history will have occurred during the Trump administration. But his complaints about trade deficits are largely due to a misunderstanding of how international trade works. It led him and his trade advisors to a misguided decision to shift to bilateral deals and away from the multilateral focus that had largely been in place since the end of World War II, and an equally misguided understanding of what trade deficits represent and how they occur. The truth is, deficits should be expected to increase over time as overall trade increases. In the simplest terms, it means US consumers and businesses are buying, leading to increased imports. And that's precisely what happened in the first years of the Trump presidency. In 3 of Trump's 4 years in office, the US trade deficit will have topped $800 billion for only the second time ever. It also happened during the presidency of George W. Bush. But there's one important difference. During the 3 years in the Bush administration, when the deficit topped $800 billion, overall US trade set successive records, including topping $3 trillion for the first time. During the Trump administration, by way of contrast, trade will have fallen in 2 of the 3 years when the US deficit topped $800 billion, including most precipitously in 2020. The current record trade deficit was set in 2018 at $878.68 billion. That was, in fact, a record year for trade, the first above $4 trillion. But US trade, while remaining above $4 trillion in 2019, fell, and the deficit fell to $853.23 billion. In 2020, trade will have fallen again, but this time below $4 trillion, when the annual statistics for 2020 are released in 3 weeks. The deficit will not have fallen, and will almost certainly set a record. The deficit topped $800 billion through the first 11 months of 2020 for only the second time in history, according to the US Census Bureau data released last week. The 2020 deficit total will almost surpass the 2018 record, probably winding up somewhere between $880 billion to $895 billion. The growth in the trade deficit will not be with China, with which the United States has its largest deficit by far, and which led to a trade war soon to enter its 3rd year. For the second consecutive year, the US deficit with China, while still nearly 3 times the size of the US deficit with any other country, will decrease. Unquote. Now, if that's not bad enough, a report by Reuters today adds to the US company woes. Let's read you an excerpt. Headline: Trump's China tech war backfires on automakers as chips run short. Automakers around the world are shutting assembly lines because of a global shortage of semiconductors that in some cases has been exacerbated by the Trump administration's actions against key Chinese chip factories, industry officials said. The shortage, which caught much of the industry off guard and could continue for many months, is now causing Ford Motor Company, Subaru Corp, and Toyota Motor Corp to curtail production in the United States. Automakers affected in other markets include Volkswagen, Nissan Motor Co. Limited, and Fiat Chrysler Automobiles. The problems stem from a confluence of factors as auto manufacturers compete against the sprawling consumer electronics industry for chip supplies. Consumers have stocked up on laptops, gaming consoles, and other electronic products during the pandemic, creating tight chip supplies throughout 2020. They've also bought more cars than industry officials expected last spring, further straining supplies. In at least one case, the shortage ties back to President Donald Trump's policies aimed at curtailing technology transfers to China. One automaker moved chip production from China's Semiconductor Manufacturing International, or SMIC, which was hit with US government restrictions in December, to Taiwan Semiconductor Manufacturing Company, located obviously in Taiwan, which in turn was overbooked. A person familiar with the matter told Reuters. An auto supplier confirmed TSMC has been unable to keep up with demand. They quoted, "The systemic aspect of the crisis is giving us a headache," said a supplier executive who asked not to be identified. "In some cases, we find substitution parts that could make us independent from TSMC, only to discover that the alternative wafer manufacturer has no capacity available." TSMC and SMIC did not immediately respond to requests for comment. On an earnings call with investors Thursday, TSMC chief executive C.C. Wei said there was a shortage of automotive chips made with mature technology and that it is working with customers to mitigate the shortage impact. It only takes the tiniest of chips to throw off production. A Ford plant in Kentucky that makes the Escape sport utility vehicle idled because of a shortage of a chip in the vehicle's brake system, a union official in the plant said. Ford also will idle its Focus plant in Saar Louis, Germany, for a month starting next week because of chip shortages. The situation is unlikely to improve quickly since all chips, whether bound for a laptop or a Lexus, start life as a silicon wafer that takes about 90 days to process into a chip. The long and short of it is, demand is up about 50%, and there's no asset-intensive industry like ours that has 50% capacity lying around, said Mike Hogan, Senior Vice President at chip manufacturer Global Foundries and head of its automotive unit. And the Huawei effect. Tight capacity and soaring demand has made it difficult for chip producers to absorb two shocks from the Trump administration. First, the White House in September banned Huawei Technologies, the Chinese telecommunications giant and a major smartphone maker, from buying chips made with American technology. Huawei stockpiled chips ahead of the ban in order to keep the building what products it could after it took effect. And Huawei's rivals, eyeing a chance to grab market share, started snapping up chips, analysts said. Second, the US government enacted rules that bar SMIC from using some US tools to make chips, a move that has prompted at least some of SMIC's customers to look for a different chip factory because of concerns that production could be disputed or disrupted. There's a fear of using a Chinese chip factory if the United States is going to put them on an entry list, said Daniel Girl, Chief Business Officer of Ultrasense Systems, referring to possible further restrictions. The Commerce Department spokesman declined to comment on the implication of the SMIC and Huawei blacklistings for the auto sector, but said that the top priority was to ensure the Export Administration regulations protects US national security, economic security and foreign policy interests. Analysts said the automotive chip shortage is likely to persist for as long as 6 months. An Auto Forecast Solutions report estimated the global auto industry had already experienced lost volume of 202,000 vehicles as of January the 13th. Executives at automakers and suppliers said they're adapting production schedules to protect chips used in higher profit vehicles, and companies are weighing sourcing chips from more suppliers and increasing inventory levels in the future. It's four-dimensional chess all day long, said one auto official who asked not to be identified. Unquote. It's the end of that article. So, if we add to this China's also apparent intention to purchase less dollar-denominating debt at a time where America has to increase its debt in order, as they see it, to buy their way out of recession, therefore less bonds are taking up in future, this could serve to grossly undermine the ability of the US Treasury and the Federal Reserve to provide the relevant instruments in order to fund planned spending. And so, technically, we have a potential hat trick, all in favour of China. Now, let's make something absolutely clear. The need for the West to curtail China is, in our view, essential. And yes, we have to undergo pain to do so. However, it's far better, more effective when these matters are thought out, planned and implemented strategically with global cooperation, rather than what's appeared to be a knee-jerk, bully-type tactic, which in the short to medium term harms the very nation which is imposing the sanctions, tariffs or embargoes in the first place. Now, you may be asking, why is this important? Is it a political statement? No, it's important to gauge the effect on the US economy all this has and could have. And the US dollar in particular, which, as we all know, then has an effect on precious metal prices. It is yet another factor, a geopolitical commercial factor, that we should recognize and evaluate when assessing the right level of precious metals to own, to buy, or later to sell. Now, for interest, early this morning, gold has risen a little since yesterday and stands at $1,854, and silver touched $25.75 earlier today, but has fallen back a little, but still in positive territory, at $25.46. And please do not forget that tomorrow we shall be publishing our normal gold and silver weekly update. So a final reminder, we've placed links to all of the videos mentioned, plus the China playlist in the description box below. Please share your thoughts on what we've discussed today. And meanwhile, thank you so much for listening. And if you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they are published. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.